Let's talk more about the bank's trade. Joining me now is Gerard Cassidy. He is RBC Capital Markets co-head of Global Financials. Gerard, good to see you today. It really feels like, and you hear this on pretty much every earnings call over the past few quarters, that things are really firing on all cylinders for the big banks especially. What do you think is the biggest risk for the bull case in banks right now?
Thank you, Leslie, for having me on the program. And I would say the biggest risk for the banks would be a reemergence of inflation in the second half of 2026. If we see inflation running at 4 or 5%, and it forces the Federal Reserve to reverse its monetary policy from monetary easing and lowering short-term rates to monetary tightening and raising short-term rates, that to us is the biggest risk to the bank stocks as we look out into 2026.
And presumably that's because of the risk of a flatter yield curve, as well as a potential headwind for credit quality. Is that right? How are you thinking about credit quality, particularly as we think about the interconnectivity between some of those NDFIs, the non-banking sector, as that continues to become even more interconnected?
Leslie, you're right. If they were to raise short-term interest rates, that would certainly flatten the yield curve and would take away the benefit of growing net interest income. And the bank stocks, like many stocks, they discount the future. So what investors would also take into account is rising short-term interest rates could lead to a recession, which then turns into a credit cycle. And to your point, credit today is very resilient. The de-risking of the American banking industry has been very effective post the financial crisis. And so as a result, the banks are in good shape. Now, as you said, on the interconnectedness with the loans to non-depository financial institutions and DFIs, as you referenced, right now that's very healthy. And the banks have done a very good job with that business over the years. But to your point, it has grown very rapidly, the growth in that category. And that has our eyes wide open to maybe potential problems down the road.
Yeah, and we saw little bits and cockroaches, as I guess Jamie Dimon called them, back a couple months ago with regard to bankruptcies and, spotlighting NDFIs. I'm curious, when you look at the year-to-date gains in some of these bigger banks in particular, they're pretty mind-boggling when you think about it. Is there room to run? How much of all of these tailwinds are already priced into this sector right now?
I think there's some, but to your point, Leslie, about cockroaches or mice, whatever you want to call it, right now we don't see that at all, and maybe down the road. But coming back to what's priced in, as you just pointed out, the stocks have done very well because of the expectation of what you highlighted earlier in this segment. And what's really going to be interesting is we have one final piece of bank deregulation, and it's the most important piece, known as Basel III Endgame. We think we'll see that proposal come in the first quarter of 2026, and this will give a further pieces of evidence to investors that the regulators are very constructive and are working with the banking industry. But the other part of the story, Leslie, and I think this is what's going to carry 26, at least initially, is the growth of the economy. You saw the real GDP numbers this week. Now, if you take the nominal GDP, so that's not the real GDP number, this factors in inflation, of course, real GDP. When you look at the nominal number, the growth was about 8% in a quarter. And the reason that's important is that loan growth, when you go back over 75 years and do a regression analysis, loan growth in the banking industry is linked to nominal GDP growth. So if we continue to see 3 to 4% real GDP growth and possibly 7 to 8% nominal growth, loan growth could accelerate, which is not really discounted in the prices today.